Afternoon, everybody. This is Michael Sadaka from Minyanville. If you can hear us, just pop something in the chat box real quick. Make sure everything's working okay, and then we'll get started here in a minute. And turn my phone off. All right, we're all good. On the line today, I have Kevin Ferry and Vince Foster. Just a little background on Kevin. He's been trading interest rate products for the last 25 years, and he's literally wrote the book on Eurodollar futures, which is a LIBOR future. And Vince Foster, he has more than 15 years experience in the securities industry, and he's currently an interest rate strategist at a commercial bank. Welcome, guys.
Thanks for having us.
So I guess we'll start off with the taper decision today and everything else they put in the statement about forward guidance and the threshold. If you guys have any comments on that, we can just kind of go from there.
Sure. Want me to go first, Vince?
Sure.
All right. Well, a quick thing for what I would say is that the Fed has pulled off a fast one from an analytic standpoint because they've got the media buying into them, what I would call burying the lead, and by focusing on taper. And so 5 and 5, the $10 billion taper would have been something that would have been heralded back in September when they avoided it. From a price standpoint, the interest rate curve went in virtually at the same place that it was in September anyway. So the key that I would say is that the Fed had one additional quarter of extreme accommodation because by keeping it where they were actually doing more than they were before from the supply side of the equation. So now they're backing off a little bit. But I would say that the key important issue that I'm trying to get or at least focusing on rather than taper is that the Fed is solidifying the framework for exit. And all the niceties that they have to say about the unemployment rate or forward guidance are merely smoke screens to keep people buying into the idea that they're not tightening yet, which is fine. We know they're not tightening yet. But I think that the opportunity will still be by watching in the belly of the curve for people to finally realize that it's still too low for not just the growth rate and the potential pop that we'll see in the first half of 2014 in growth, but also for what they've already done. And so some of the things that Vince will point out, and we've been looking at, that there is now a large optionality, forward guidance or not, of low risk hedges that the belly and the near-term part of the curve, especially in Eurodollars, reds or greens, is actually presents an opportunity to bet that the pace of the recovery quickens faster than the Fed's forecast. And if not, then you're going to get paid a lot to own the other side and ride them out. In fact, a historic amount of carry.
Do you think it's fair to say that? And we could talk about the conspiracy on floating the taper back in the spring, but I mean, do you think that it's fair to say that now that they've got the back end kind of focused on tapering, and now they're going to want to kind of walk the front end up while they kind of keep the back end anchored? I mean, is that kind of?
Yeah, I think to the extent that they want to mess with mortgage, you saw the mortgage data down again. That they will attempt to talk about retwist or how they adjust in the future. When he talked about the buckets, maybe messing with the buckets, that kind of monkey business. Again, I would say don't get caught up in it, is my advice, because when you look at back month Eurodollars already, we're seeing prices and spreads that would say you can bear the risk of those possibilities.
Yeah. So you want Mike to show the spread, the red gold spread?
Yeah, that's all. I mean, I think it's a great example that shows not just from September what took place, which was that the front months had a dramatic ability to come down. They came down 100 basis points while everyone was focused on the back, and that the spread now is at a new wide. In the prior 6 attempts against 300 basis points between 2015 and 2018, we broke through that today, hammered at the end. We saw the market right before was down 6.5, 7 basis points, and Vince just told me that they went down 10 basis points with the front up 3. So these things are now trading over 300. To put in perspective, in 2008, in the height of the movement of the curve on the crisis, they went to 319. Oh. So this is what I call the ridiculousness of forward guidance. All it does is produce a line in the sand in 2015 beyond which there are dragons. And those dragons are out there for everyone to see now. And so if you want to mess around, you can own that stuff out there and buy very cheap optionality that or the reds or the greens, that this comes faster because it's fully embedded.
Okay, so can I just explain to him kind of what you're talking about here, just to give?
Sure.
So by red, so just for a little bit of reference, these Eurodollar futures, which discount 3-month LIBOR futures, so spot 3-month LIBOR is like, call it 25 basis points. Well, so the December 15. Excuse me. Are you saying you could short the front and then buy the back? How far would you go out, Kevin? I mean, we're not recommending anything, but just kind of as an example.
We're just saying, where's the gamma taken out? Where's the optionality that the market has fully discounted what the Fed is already talking about? And that's what is amazing about the questioners of the one guy began to talk about the term structure and then he dropped the ball. They should ask him, how do you feel about 300 between 2015 and 2018? Because if there's convergence, it's the mother of all convergence trades to go out there and wait.
Right.
But in fact,
so for instance, June 2015 implied 3-month LIBOR is at 53.5 basis points.
Marginally, right, which is just common for the shape of the curve, right? So
right.
If you right now or going forward into Q1 14, what you'll find is, forward guidance or not, very inexpensive insurance risk possibility that the threshold for the Fed's forward guidance comes forward. Like, what's the worst thing that could happen? Things get better. That's kind of what people have avoided, right? One of the things that we were talking about to Q and the rest of the listeners is that 2013 ended up being a very aggressive accommodation year with embedded fears about what transpired in 2012. But overall, the Fed remained highly accommodative, and nothing really bad happened. We just had sluggish growth, which is okay. And so the risk, I think, now is that it begins to accelerate faster than the Fed's forecast, and people become more confident, which they should be. And so I think that you now have the Fed. On the other note, that was not touched upon, amazingly, by any of the journalists in the room, is the Fed entering into shadow banking because they are going to, with the new reverse repo facility, they have a fear that the floor in rates won't stick for them. So they're doing everything to create new products that they'll be able to floor the interest rate when they need it.
So just real quick.
That's not what I'm worried about. I'm worried about it going up too high. But the fact is, it again plays into the idea that you can't bury the lead. The end of large-scale asset purchases, the end of quantitative easing, the move back to a rates regime is coming. To America. It's coming.
And the market is going to, if it hasn't already, is going to start pricing that reality.
Correct. And to put it even more thoroughly, beyond the Fed's forward guidance, it already is.
Right.
Okay.
Which points to the spread and the Euro curve.
Right, and where it breaks behind 2015. In other words, promise or not, right? It's not a promise, but we have to react, right, as logically as we can to the Fed's prodding. And all that I'm trying to point out is that's what happened. Amazing, right?
Yeah, that's back to the good old days, right?
Markets acted as rationally they could when everyone was telling you something crazy was going on, right? Okay, if you tell me you're going to stay here until 2015, then I'm going to go play behind there. And that's okay. And here's the caveat that when Michael asked me to speak, is this is why. The open interest in the greens for 2015 now exceeds the whites. 2015 is red, 2016, okay? So from mid-2015 to mid-2016, the open interest now exceeds the front month for these contracts. Never before in the history of their inventions, since 1983 when we invented them, has that happened. And so
because the Fed's made 14 obsolete, though, kind of.
Right, they took it out of the picture, so we went and played somewhere else. So all I'm saying is that the potential unintended consequences of forward guidance are already manifesting themselves with an inordinate amount of bets right where they say the line in the sand is. Is that right? So
the fulcrum around the forward guidance has got the potential. So kind of back to the reverse repo. So you're saying that the Fed is that they're focusing their I mean, that's kind of the sideshow that didn't even get discussed today, but in terms of focusing on the floor of interest rates, so because due to collateral specialness and all that, that the risk is not that interest rates go back to zero. It's back out in the 2015 where forward guidance starts to get priced, or excuse me, where interest rate hikes get priced regardless of what forward guidance is.
Correct. Or it comes forward. It's exactly right. What I would call the great unpredicted possibility that we return to normal, right?
Okay,
because we just spent a whole year trying to, with a lot of fears that just never really came, and we still have sluggish growth. Vince, you might want to talk about why we think that's going on with regard to the structural issues that the economy faces, but. If those issues are to resolve themselves in a better way, is all I'm saying, then you have a historic opportunity to mess with the line in the sand, like Bugs Bunny does with Elmer Fudd, and just keeps drawing it and moving it forward and daring to cross it. And that's what I think is going to happen in 2014.
Just to give some folks a little bit perspective on the Treasury curve, Mike, if you could throw up that 5-year chart back from the last tightening cycle.
Sure.
Because I think that illustrates what Kevin's saying because the euro-dollar curve is not something that a lot of people play in. I mean,
yeah,
I know a lot of institutions do, but a lot of people are probably more familiar with the 5-year. But you'll see that. There you go.
This is the last cycle.
Yeah, so this is the last tightening cycle, and you can see when they finished, when Greenspan finally got to 1%, and the 5-year was at 2%. Well, the 5-year immediately backed up, and they kept rates at 1% for a year, a good year before they started before they were ready to hike. And you go back through the transcripts and read about what Greenspan was trying to do with the recovery and whatnot. But you'll notice the 5-year, immediately when the 5-year got a sense that the economy was, starting to accelerate, and you can see on the chart I wrote, nominal GDP year-over-year growth rate peaked at 7.1% at the same quarter as the 5-year hit 4%. Mm-hmm. So the 5-year basically went directly to where it thought the Fed was going to go before forward guidance. Greenspan, it wasn't called forward guidance back then, but I mean, correct me, Kevin, what Greenspan did.
Well, whatever you call it, incremental movements, but
measured rate hikes.
That movement that you're witnessing in that prior cycle is exactly why they are leaning on forward guidance, or what we call the Jedi mind trick of all times, to try and keep that from happening. I don't know why they don't want it to happen. What are they afraid of? I don't know. To me, it's a positive sign, right? Which is why I'm saying that the 5-year note, and thus that belly, the green pack, should go somewhere between 2 and 220. I think it should go to 220 in the first quarter of 2014. The reason being just that, because it should be a rough approximation of the growth rate, the nominal 5-year yield over the real growth yield. So if you fudge a little bit of 1 point whatever, 1.5, if God forbid we go to 2% on inflation, then you could add that back on there, and you could see why 220 is still a very conservative rate, forward guidance or not, ZIRP or not, for the 5-year to trade at. And all I can say is, if people are long a bunch of green packs because of convergence and forward guidance that they're not going to hike the rate, and the 5-year note goes to 2, watch out, because they're going to head for the hills back there is what's going to happen.
Right, and that speaks to something that I kind of addressed a couple weeks ago, and just so you guys know, convergence is the idea of buying the futures strip and allowing it to roll down to spot LIBOR. And so my thought was, and this goes back to some information that was passed around that Harley Bassman had pointed out that, and one of the reasons I was a little less worried about tapering is because of that the market had already kind of, the convexity/gamma risk in the bond market, which is subject to a large degree in the long end of the curve due to the mortgage-backed security market, and that's what you witnessed in May and June when the market blew out so fast. That was essentially a gamma convexity blowout in the mortgage space. And we can get more technical on that, but I think the point is that already kind of flushed through the system. And so going into this tapering, you had a lot of the market price risk in the bond in the long end of the curve had already been removed via the convexity blowout, because all these mortgage backs had already basically extended as far as they would extend. But now, to Kevin's point, is you have these positions long, quote unquote, convergence forward guidance trades, assuming that rates are going to stay at zero for until 2015 or whatever. And those trades, correct me if I'm wrong, Kevin, are implicitly short gamma. Is that correct?
That's right. Well, there's a natural short base to the strip because of the way the contracts are. But we know that this is true, right? In other words, you could see a day, if this goes wrong, where someone, perhaps a large West Coast bond fund manager, might say, hey, you told us this wasn't going to happen.
Right.
Because they've bought heavily into the concept that these things are going to converge upon the ZIRP. And so as a trader, I'm just saying, well, what's priced into the market? Where's the opportunity? Where's the low-risk insurance? Where's the place where I can go, buy cheap lotto tickets? And they're creating this playground, which is, look, things go wrong out there. I've been out there during long-term capital management. I've been out there during other events, and it's a disaster. That's where we get hurt, whether they're swap books or when we think we've got them hedged properly. So an abrupt move in the shape of the term structure out there, either caused by, God forbid, the economy accelerating or some exogenous event, could create what I think is going to be the real story of 2014, because we just never had so much interest, so much
positioning.
So much positioning, just saying, okay, I'm going to give you the next 2 years, Ben Bernanke, and I'm going to go play somewhere else. It happens to be the most volatile part of the belly of the curve. It doesn't seem to scare anyone.
So to give you guys an idea of when he's speaking of the open interest, so I'm looking at SEP, which is $972 billion, and call it DEES at 1.2. So you're over $2 trillion notional positions out there, and you can't say whether they're long or short, but you could imagine that there's a lot of pent-up volatility if something were to go unexpectedly, I guess is how I put it.
Well, and for the first, there's a natural, because of convexity. In other words, if you just think at its most basic, there's a bias for us to be short them, right? Because if rates go down, we borrow the losses with the lower prevailing rate, and if rates go up, we get to lend the gains at the higher prevailing rate. So that's the nature of convexity in the term structure of forward futures, right? So if that's the case, right, but forward guidance messes with that, because it creates the concept that people are supposed to go out there and be long them and ride the convergence down, right? And so you have to believe in A, slow growth at best, and B, the Fed, right? The Fed is able to do what they're attempting to do, which is what we are, and that is regulate markets. Right? The Fed has been using LSAPs to help determine the market price of securities. They need to stop that. They realize they're bigger than the mortgage market now, so they're stopping it. Whether they stop it slowly or quickly, my only point of this discussion is don't get caught up in that. They're stopping it.
Well, in what I tried to address this also a couple of weeks ago, in that it's not necessarily what they want to do with forward guidance, because the problem is that you have a big pent up position, and the data. Let's face it, the data. It's not a straight line out of the recovery. I mean, it's been pretty damn lumpy, and so I mean, you could conceivably see, January payrolls come in at 200,000 and February come in at 50,000. Maybe not that big, but the point being is that there's a lot of things that can go wrong, because this isn't necessarily a smooth trending recovery. It's very lumpy.
Which is why the Fed has done what they've done and continue to do what they are doing. But again, those type of operational issues that the Fed is moving on, right? They don't trust what people like you and I might do again in the market if we get to weigh in on what the pricing is, and that's the serious issue about this Fed, whether it's regulatory issues or the Volcker rule, whatever, BlackRock being a SIF, and all their SIFIs, all those things are part of the Fed's concern that the market someday will again weigh in on what they think the price of these securities should be. And maybe we'll take some questions, but that's the point that I was making to Mike, that 2014 is people should be encouraged. They shouldn't look beyond and talk about what happens after 2015. We're looking to 2014 as the first year in years that we're going to get to weigh in again about what the price of these things are. And that's
can we bottom line it by basically saying that we think there's way too much focus on, I say we, I mean you and I think there's way too much focus on tapering, and that the market is kind of looking past tapering and it's looking at the next operation.
Correct. And that a lot of the confidence that the Fed is getting to what they're doing is coming from the very structures that we just described, right? And so I don't know what to do with accurately priced. I'm about where are the opportunities that those relationships are going to change, and and so these are historic. That's all I can say. We're out.
Well, so you're saying that you're licking your chops. Is that what I read?
For the first, well, as you know, I took off the second half of last year, and reporting from Napa Valley, because the exciting time is to I can't do anything with central bank determined prices, but if they're going to give me a chance to weigh in again, then I think it's exciting and the way things are supposed to be. We're getting right. We can't get.
It's been a long time.
We can't get trapped in the idea that we're all going to live in Oz. We've got to go back. We've got to go back and see if there's a market for this stuff, and the exciting opportunity in 2014 that I see is that we're finally going to go do that. Whether it's slowly or quickly doesn't really matter. That's the key, is to realize that's where we're going.
Well, and I'll just say real quick, we don't have time to get into the structural trap nuances, but
we have time. I think we're good to talk about it some.
Okay. Well, I was just going to say, I mean, and I'd like Kevin to kind of give his, because basically when I started writing about it was when he kind of alerted me to the thesis, and but I was going to say that one of the remedies from the structural trap to kind of start at the end is to let nominal rates rise. And one theory that I had been exploring with Kevin the last couple of weeks is whether or not, if the Fed does not allow nominal rates to rise before they should, is it possible that the market kind of takes over and does it on its own? But
Right.
Kevin, could you kind of give us
just the quick and dirty is that we hear quite often about the idea that a Minsky moment or a liquidity trap. We've never believed that at our firm, and we were influenced by Duggar and Uribe in their work on what the Japanese experience of a structural trap. The problem was in America, as soon as you brought up Japan, you would either be faced with doomsayers agreeing with you or really intelligent people saying, we're not Japan. They weren't taking the time to listen to what we were saying was that there's plenty of liquidity. That's not the problem. The problem is overcapacity, the entrenchment of the political system to support archaic businesses and industries that need to reduce capacity and never are forced to because they're bailed out, carried on, large amounts of the debt, the new programs that were only applied to pay for old debts. And so there wasn't any reduction in the capacity of the banking industry, and there wasn't any reduction in the capacity of the globe per se, because other places were still expanding it. And that's how you get in a structural trap from that you can't achieve the one goal the Fed seems to be missing, which is the rise in the inflation rate.
So they're trying to make aggregate demand catch back up.
Right, which is what I'm saying. The worst thing that can happen under their scenario is that everybody just decides to go party, and so, but the reality is that's where they have to think about, and why they've been so cautious, because they recognize that whether it's the financial industry, and see the uniqueness of the United States experience in the crisis was that the archaic overcapacity industry that was being supported wasn't just GM. It was the financial system.
Right.
The capacity of the financial system continued to increase, even though it's big and idle and useless, and most of it sits in excess reserves. The needed reduction in capacity in the system did not take place, thus causing the market to what we call get structurally trapped in the political system. Now, with the first budget, the naysayers of the debt sayers, the debt implosion, those type of things seem to be moving the arrow. So if you were to, the concept being, the common thing is drop the currency. Hopefully the negative rate, is not so negative that it caused the currency to collapse and blah, blah, blah. You can get out of it. America's in a unique situation where I don't think that's what they need to do, right? In other words, we've messed with negative rates long enough that, in fact, you could have an uptick in the demand side that it would at least pull us closer out of that situation that we're describing. But the key difference is that it's not a liquidity trap. My God, there's $3 trillion worth of liquidity sitting on the Fed's balance sheet.
Right.
Right, and money is not capital, as Vince so aptly wrote for Minyanville before, right? That's the confusion, right?
Right.
Money is infinite. Capital, right? Just because
capital's scarce, right?
Right. Well, it should be, but we're dealing with what happens when you have a globe that's awash in it, because it's awash in so much that the two are used interchangeably. And so that's the philosophy and again, I think that we've been in that situation. The key, my nuance is that I think we've got a chance of coming out of it.
So
well, and will in chicken or egg, not to pun your rooster back there, but is rising rates, are they a product of escaping the structural trap, or do you need them to rise in order to pull you out?
Both, right.
Right.
Which is that's a key, right? If we get the way in and we could raise that nominal cost of capital, right? If the cost of capital is zero, then you're going to have too much of it, right? People have been saying to me, oh, the stock market's up. And I'm like, yeah, people love free money. So out here in California, I can assure you, there is a bubble going on. It's the biggest real estate bubble since 2013. The agents. We dealing with homeowners. There's bidding wars in the driveway. 6 people yesterday at a home we went to were drawing the property sold before anyone could even get in the door. So the economy is uneven, but it's still going strong in parts where the wealth effect has been most meaningful. So that's my report from California.
So this is
with
a good.
cab in hand.
So we have one question since we're talking about the structural trap. Do you guys think, just going forward next year to 3 years, the biggest problem we're going to be looking at is inflation or deflation? And this is a little bit more of a basic question. We've kind of been off in some of the other stuff, so we'll go back to this.
I didn't know there was going to be direct questions, Mike.
Oh.
For me, it's inflation, because finally, as opposed to people who have been telling you to worry about it since 2008 when they started easing, I'm seeing enough evidence elsewhere to say, okay, it looks like it's finally gaining some traction, right? And so even though LSAPs are going to start, the fact that we're still in an extreme accommodation standpoint, then is it going to be even? Is it going to be readily available that you can point to a basket of core CPI and see it? I'm not so sure, but clearly I would say that I don't know if even fear is the right word. For me, the focus should shift to the traction of the Fed's enormous liquidity push and I'm not sure we'll be so happy about it when they get it right. You know what I mean?
Yeah.
They say it's a target, it's a goal, but I think they've got a very good possibility of achieving it, and then we're going to realize it's not all that great.
Yeah, I'm kind of more in the deflationary camp, and it's really it's back to the money and investment. I just think that we've had such a drought of savings, and that our middle class and the baby boomers are basically, as a generation are broke, and they're going to have to start. Savings is going to have to go towards consumption, and that just is going to be a drag on prices. And so, I mean, you see the PCE, the year-over-year PCE, which Mike, you and I are always looking at in terms of the relationship to nominal GDP and long-term interest rates, and that has continued to decelerate. So that's kind of the way I look at it. Now, that's not to say that, if interest rates start kicking up and some of this, I mean, that's the thing. If a rise in short-term interest rates could unlock a lot of velocity real fast. And I guess that goes back to what Kevin's saying, is that 2% target might not be, that 2% can turn into all of a sudden you got, people forget back in 2011, when they decided to cut off QE2, a lot of it was because inflation was going nuts. I mean, you had PPI, let me just pull it up real quick. PPI in 2011 peaked at 7%, and so, now it's 0.7%.
Yeah, that was over 6 for sure. And that's what I would say. I think it's going to be uneven, but if you start to unleash that velocity in other parts of whether it's Texas or here in California or say even the Dakota with what's going on with the energy industry, those areas are going to experience localized inflation.
Yeah.
And that's really all I'm saying about, where the number itself may be maybe already masking, in my opinion, certain areas of the country that are already experiencing.
So you think that because we have low inflation just through CPI and PPI, that it might be a little bit higher out in reality, basically is what you're saying? Yeah,
locally. Well, yeah, and I would say not even a little. I'd say a lot. I would say here
in different pockets of the country.
In pockets, right.
Yeah.
Here being one, I would classify it as an all-out bubble already. And the real estate agents are telling me it's as tight as it's been since 2013 years. So you're talking about the height of the tech bubble. And there's much more underlying profits and financial stability than there was back then. So for if you're talking about tinder that could spark, I think there's more now than there was then. So. All right.
All right.
Any questions?
Yeah,
What about
we have a few questions coming in. If anybody else has any more questions, just put them in the box below. There's a question box and a chat box. I have a question myself. I know you've seen, well, maybe just this is something to talk about. I know I've seen Kevin reference this chart before. It's of March 2014 euro dollars, and what I want to reference is down here in late June, when everything started freaking out, and I remember you pointed out where the Fed basically, all the Fed heads came out and said, oh, look out, we're not tightening, hang on, everybody. And just since you've been on that side of the street before, if you can kind of talk about maybe what they're seeing and how they react like that in the future.
Yeah, I think that when this is why I was quite worried, to tell you the truth, when the idea of tapering started. The whole market was dropping, but this part of the curve was dropping every bit as dramatically as the stuff in the back. So we believe that there was some influence from China cracking down on some of their credits at the time. And you saw SHIBOR leaping, and so, but it also showed that, as Vince pointed out, that quantitative easing had created an exchange between the rest of the globe in emerging markets and the United States with regard to flows and funds. And so as that concept of tapering hits, you saw the emerging market disaster. You can see here that these short rates, near-term short rates, began to jump up in what was really a monetary squeeze. In other words, the system did not or could not create enough funds once they were being demanded by the world, especially the emerging market world. And so that's, I think, was influential upon the Fed's decision not just to keep going, but to also then determine this idea of forward guidance, saying that this isn't tightening. We're going to keep right there. This is where they began to worry that the market had jumped the gun on them. I just think it's what it's what happens when systems, economic systems, have to make adjustments, long-term adjustments. I don't think it happened by mistake. And so this second wave up that you're witnessing now is why all I'm saying is this is the opportunity of a lifetime.
Yeah, I think essentially, and I have no, intelligence on this, but it looked like he had a lot of short dollar carry trades in emerging market credit predicated on the Fed defending the inflation target, i.e. weaker dollar, i.e. keeping funding costs low. And then when that commitment via the taper mentioning, basically the Fed said we're not committed to it, then all of a sudden it was Katie bar the door, and they blew out Eurodollars because their funding costs were $1 and they needed a hedge.
Right, and in fact, we got out well into the normal, what we would say is that cluster of normalcy there in August and September. Look what it did since then with this continual flux of money that flowed into the system, driving these to all new time lows, right? Everyone was talking about where the bond was. These were making new 35-year low ticks in high prices. And if you've noticed this little jig that it's had since then, we attribute that to the firming of the Death Star, what we call the Death Star, that they are flooring the rate, that these counterparties now, right, have a place to go and play, and we expect that rate. It started at 1. It's now fluctuating around 5, 6. I think you're going to see 8 pretty soon, and then 12. And then the game is on. I'm not concerned about the Fed's ability to floor the market.
Well, and I was just going to point out this a little as an aside. Compared to what the taper fear was back then, it gives you an indication of what the market had. The positioning is today. The emerging market CDX is up 18.18 bips on the day. So not a lot of positions in what was a big blow up before.
Right. And I would say if you look at what happened there between April and June on Mike's chart, and just put that out on the curve to where the greens are, this is a lot of people believing that nothing's going to go wrong. And look, you know, you could see the surge back up and then a big wipeout. I mean, that spike in rates doesn't come because everybody's got the proper position on. And I think that, you know, at least these were up front at the time, you know, that multiply that by $1.2 trillion and put it out in the curve where everyone's got to sit there and hope everything goes according to plan.
So let's get to another question. We didn't really cover this topic so much with Yellen. Well, I suppose that Bernanke's last meeting will be January, which is the 28th. Do you think anything's going to be different with Yellen, just about her policies, just going forward?
My philosophy, as we wrote on our blog, is this: the Yellen Fed was conceived in dovishness and will go down in history as exit. I think that this was a prerequisite. They wanted someone with those credentials, right? Someone who was believed by the market to be easy. And I think that her time at the Fed, which I don't think will be long, will be focused squarely on returning the Fed to a rates regime. Whether it takes 2 years or one, we'll have to wait and see.
So you think only one term then? She'll be done in 2018, January 2018.
I gotta say, yeah, I gotta believe maybe Stan Fisher. I mean, he's not spring chicken either, but yeah, I would say that she's one and done, provided that she does a good job.
Yeah. My kind of thought is that, and I agree, and it probably, you know, it could depend on who's elected president. But you know, I kind of look at it from you know, go back and what can go wrong, and if she's known for exiting, is that you know, we've only had two Fed chairmen. Most people only remember two Fed chairmen, and I wasn't really. I mean, I was in high school when Greenspan took over, and I think that was '86. But I mean, I kind of feel like the markets want to test. They're going to test Janet Yellen at some point, and it's probably going to be on this exit forward guidance, you know, where Kevin's been talking about in terms of the belly of the curve. And, you know, Greenspan had 1987, and Bernanke had, you know, 2007, 2008. So, you know, that was a year after they stepped in. So, I mean, I would look for, I mean, it's not going to be all, this is a very delicate situation. And I kind of think that Stanley Fischer was Obama's concession. He probably, I think, you know, the rumors were he wasn't really crazy about Yellen. He worried about her crisis-fighting ability, and so, well, Mr. Crisis is Stanley Fischer when he was at the IMF and elsewhere.
Right.
So I think, you know, it's like Bernanke's date with destiny and quantitative easing. I think, you know, maybe they have a date with destiny too at some point. Don't have no idea what that would be, but
let's go find out.
Yeah.
You know, that, I mean, it's been a long time in the wilderness here. So.
Yeah.
So we have another question. It seemed like today with the forward guidance that they're going to try to push out the zero rate into 2016, maybe not just today and save it in their back pocket for a little more ammunition, but it seems like they might be trying to move that direction in terms of easing a little bit more. Do you guys think that's where they're going with inflation? It seems like, because it seemed like today they're putting a little bit more emphasis on inflation rather than unemployment or other things like that. If you guys
right. Well, I think they're attempting to, but all we're trying to point out through this whole, you know, this whole chit chat is that they're just beyond it. They're causing another reaction that is more extreme. In fact, is it's as extreme as it's ever been, right? And so I don't know if that's a good thing. Is all I get, right? So, you know, I'm not a fan of it. I mean, they've hitched their wagon to forward guidance because they don't trust markets, and they're going to try and regulate markets. And you know, for guys like me, it's like, well, good luck with that. I'm a student of markets. I think markets are great instruments of you know, knowledge. The feedback loop is important.
Yeah. Kevin, let me ask you this. I mean, do you think if they had 1% inflation, but it was 4 to 5% nominal GDP, they probably wouldn't care, do you think?
Yeah,
right?
They'd probably stay on it. I mean, you know, and shoot for 5 or 6. They know they have.
Yeah, as long as real GDP's up, they don't care if there's no inflation.
So the mix, the mix becomes, and that's right. I mean, the Fed's only missing one target right now. I mean, it's inflation, and I'm like, okay. Well,
I just think that
I grew up in the Volcker Fed. I mean, we weren't really, we were never really concerned about inflation being too low.
I just kind of feel like if growth does, if we are going to see kind of a growth cycle, and you can argue about how sustainable or short or long it is, but that inflation is not going to be as big of a problem. They're worried about inflation at 3% nominal GDP because there's no real GDP, but at a higher growth trajectory, inflation suddenly doesn't become a big issue to me.
Right, and you can get both, and then they're going to have to adjust.
Yeah. Right.
Just looking at the questions here real quick. This is maybe a basic question, and I know you guys kind of focus more on the shorter end of the curve, but where do you see the 10-year moving next year? And then maybe I have the chart of the 5-year versus the 10-year, if you guys just want to chat on some of the more basic questions.
Yeah, I think they're giving it away obviously in the 5. So, I mean, if the Fed could adjust the bucket, the Fed might want to play around with a mini twist, an exit twist type of thing. Like I talked to Mike today. The mortgage rate, maybe the spread may be tight. The normal configuration would be higher and wider. You may get marginally higher and still tighter, right, based on what the Fed ends up doing with their concern about housing. But my own opinion is that if I think the 5-year note's 50 to 70 basis points higher, then I would say something along those lines for the 10-year note.
I see the 10-year. I wouldn't. I think looking at it from a 5s 10s perspective, we are at the extreme level of where that thing belongs, and so I kind of feel like as accommodation is removed, and inflation premiums are reduced, and the term structure is reduced, and the 5-year kind of gets closer to this 2.25 area that's fair value. You throw basically a 50 to 75. I mean, I think 3% is not impossible. I mean, I don't think you buy it there, but I certainly think if it got much higher than that, then you're looking at a material, maybe a 30-year mortgage rate above 5%. And I think what we saw in early this year when mortgage rates did get up at that level, that it slowed down considerably. So I think at the end of the day, the long end of the curve is going to discount growth and inflation, and right now that's around 3%. And revenues are growing around 3%, and consumption is growing around 3%. You got wages growing sub 3%. So in that kind of world, assuming growth is just kind of putting along, I think it's not unreasonable to expect, even with the Fed not buying, that the discount remains near those growth rates.
Yeah, I guess my basic point was that I don't see the 10-year or even the long end running away from the 5 now.
The 5-year, yeah.
Given what we were just looking at,
Yeah. I think the bias will be towards flattening. The bias will be towards flattening, right? I mean, that's pretty simple.
Yeah.
So we have another question here. Do you guys see any possibility where the short rates could rise without the Fed moving? Or do you think they would rise before the Fed starts moving or anything like that? Or they can, at least?
I think that's what we've been talking about,
yeah,
right?
Yeah.
Well, just for example, like the 2-year.
Out beyond 2 years,
okay,
they already are. And so,
right.
I think that portion of the curve between 2 years and 5 years is going to be the, critical point of flex for market participants.
Well, and one thing, I mean, apart from an economic, or an inflation-induced rise in short-term interest rates absent the Fed, I think one thing that we need to keep in mind is the role of the dollar and the foreign investor, because a stronger dollar on balance would reduce their purchasing power And if you look at a chart of the 5-year or the 2-year against the JPY, it is remarkably correlated. And to the extent that the dollar continues to strengthen, I think you could see less foreign demand. Now, whether or not that sees a rise in short-term interest rates, where they're probably, holding, I'm not smart enough to know that, but it is, I think, a risk factor.
Yeah, if you could take the Fed out, you can take the marginal buyer and reduce the interest, the foreign exchange need or trade need for others, then again, who's the rest of us get to weigh in on what the price is, and that's really all I'm saying. That's a good thing. That's what we want to happen.
Yeah, that's a narrower current account balance. That's fewer dollars being exported, more am I right, Kevin? I mean, I think that's
right.
That's a positive development, but it might get a little bit hairy on how you get there.
Right.
I think that kind of wraps up our last question. We had a question about an article you wrote a few months ago, Vince, about the Fed, China, and Japan, but I think you kind of just covered that. So,
yeah, I think that was kind of the idea that I was writing. I was like, let's think about, if the Fed stays, its forward guidance in its 2015, between now and then, what could, aside from a growth, spike in growth, what could be a catalyst for a rise in short-term interest rates? And that was kind of the something that I didn't think people were necessarily, considering it as a risk factor.
Right.
So I think
it's all good. I think it's enjoyable. I just certainly thank you, Mike, for giving us the opportunity to talk about what we're watching, and I think it's going to be very important in for 2014. There's going to be a lot of opportunity. That's really all we're looking for. I think people have embedded themselves. Young traders have embedded themselves in the process of large-scale asset purchases. Now we're going to go. I think it's time to go find out if they really know what they're doing.
All right, buddy.
All right. Thank you, sir.
Enjoyed it.
We'll have to have you guys back on here in about 6 months to see how everything's playing out. But I appreciate you guys coming on, and thank everyone for listening.
Next time we broadcast live from the vineyard.
Yes, please. I'll
try and keep
fund the ticket out there.
When the sun's going down.
All right. All right, buddy.
Bye-bye.
Thank you, sir. You guys have a good one.